In the next set of videos, we're going to be talking about fixed income securities. And by definition, fixed income means the earnings on an investment are certain, that you know exactly what you're going to receive. So that implies a certain level of certainty when you invest in these kinds of securities. That is not to say that they are risk-free. So if you think about a bond, what is it? It is a form of debt. So the issuer of the bond, the person who is selling this bond, if you will, to the public, is essentially the borrower. The person buying the bond is taking the place of the bank, if you will. So just like stocks, bonds have two types of income, current income and capital gains. And of course, throughout the videos, we're going to be talking about history, the rates, returns, interest rates themselves. We'll talk about the exposure of these investments to risk. So in a brief history, if you will, essentially what we have found is that interest rates are the most important influence on bonds. So when interest rates rise, bond prices fall, and vice versa. So when you hear in the news that the Federal Reserve is considering raising interest rates, as soon as that interest rate goes up, as soon as they make the change, there is a immediate reaction to all bond prices, since all bond prices relate to interest rates. Corporate and government bond rates tend to move together. However, because of the differences in risk, they will have higher, corporate bonds will have a higher rate than government bonds. And the difference between them is actually something referred to as the yield spread or the credit spread. So if we look here, we have the Moody's AAA rated corporate bond yields in blue, and in red is the 10-year Treasury bond. As you can see, they follow very closely with each other, but typically, with the exception of maybe one example down here back in the early 1970s, the AAA corporate bonds are going to have a higher yield than government bonds. If we want to look at how bonds change relative to stocks, you see that the stock market, the red line, is very volatile, and usually it is much higher than the bond yield is. Now, there are times, certainly, when there are corrections in the stock market where it may fall below the bond yield for a time. But you can see also just the relative certainty, right? The relative, we'll call it, lack of volatility in the bond market is a rather smooth growing rate of return over time. So what kinds of risk are there? Bonds are exposed to 5 different kinds of risk. Interest rate risks. Since bond prices change with interest rates, that can have an impact on the value of the bond, of the investment. And interest rates are certainly negatively related to bond value. Purchase power risk. Since bonds have a very long lifespan, we can assume, obviously, that inflation is going to erode the purchasing power of debt. So over time, the returns, the cash flows received, will not be able to purchase the same amount as earlier cash flows. Certainly, bonds are affected by business and financial risk, the actual risks that come from the companies themselves. Liquidity risk refers to the ability to sell a bond at a decent price or at the current value. And we'll find that for some bonds, this may be an issue. For other bonds, it's not an issue at all. For government bonds, for instance, government bonds are very liquid. It's very easy to sell them at their current value. Some corporate debt, that may not be the case. And call risk. There is a feature we'll talk about called the call feature, where the issuer, the person who's borrowing the money, can actually require the investors to sell back their debt to the issuer. They do this so that they can refinance the debt for the most part. It could also be to pay off debt, but there's a separate element or a separate characteristic that they can use to retire debt as time goes along if they want to pay off early. So why should we invest in bonds? They provide current income, and quite frankly, this is really what most investors are looking for. They're looking for the cash flows that come from bonds, because as long as the issuer doesn't go bankrupt, you're guaranteed to get the cash flow. They could provide some substantial capital gains from time to time, but not that you would expect that in the same way you might expect with stocks. Some bonds could provide some tax-free income, and of course, since of their certainty, they can be used for preservation of value and also for long-term accumulation of value if we can reinvest those cash flows. So how do interest rates and bonds work together? So the behavior of interest rates, obviously we talked about a couple of times here, is very important. Interest rates and bonds move in opposite directions. So when bond markets are bullish, that implies that stock prices are rising or bond prices are rising. That must mean that interest rates are low or interest rates are falling. We're in a current period of unprecedented low interest rates. So we typically have had a rather bullish market on bonds for the past probably 6-7 years. Now interest rates are starting to rise, so bond markets could be looked at as moving into a more bearish type of period with respect to values. So the essential features of a bond, right? A coupon, that's what you get paid, just like when you pay interest to the bank when you borrow a car. The coupon is what you earn as the lender in corporate debt. The current yield is a measure of just the annual interest income compared to the current price of the bond. It gives essentially a 1-year investment, if you will. The principal is the amount of capital that has to be repaid at maturity. For a majority of the debt, probably 99% of it, that principal amount is always going to be $1,000. Debt matures. Stocks don't mature. So the maturity date is when the bond becomes due and the principal has to be repaid. So a term bond is a bond that has a single maturity date. A 30-year bond is a bond that is due 30 years from today. But serial bonds could be issued with a time frame, so that every 10 years in the structure of this bond, every 10 years some of those bonds could become due. So this is kind of a structured buyback, if you will, of some of the debt in one of these bond issues. And a note is a bond, however, it's a short-term bond. Typically, the 2 to 10-year range is what we refer to as a note. Anything 10 years and above is called a bond, and anything 1 year and below is called a treasury bill, especially if you're thinking about government issues. So, continuing to talk about price behavior, right? So again, the price of a bond is a function of its coupon. It's a function of its maturity, and of course it's related to current interest rates. So a premium bond is a bond that sells for more than its par value. That is, it would sell generally for more than $1,000. Now, why this happens is just the interest rates change over time. And if the market interest rates are below the coupon, then the person is receiving more in income than what the rest of the market is getting. So that's a positive. So they would have a value that's greater than $1,000. Now that's really all that it means, right? There's no real better, good or bad with respect to premium bonds. A premium bond can be a bad investment just like any other kind of a bond. This is just a point where say relatively is the price greater than or less than the par value. And a discount bond is the exact same, except in this case, the value, the price is less than the par value of the bond. So the deal with premiums and discounts, again, is that there's no real value attached to that terminology. What happens, though, over time, a bond will eventually move towards its par value. So prices with longer maturities are going to be very sensitive to things like interest rates because they have a long period of time to go. However, in the end, a bond has to sell for its par value. So these are 20-year bonds out here. As you can see, no matter what happens, right, this 12% bond down here, I mean, it could, if interest rates fall, bond prices could go, if interest rates go up, bond prices could go down, and that means the value, right, the return of bonds could go up. So it could actually go above the par value for a while, but eventually it has to come back to this $1,000. So again, the certainty part here with bond is part of what this graph illustrates, is that every year, as long as the company doesn't go bankrupt, you will receive the cash flows from the coupon, but you're also guaranteed a value at the end, which is that $1,000. So if you think about how we quote prices, right, when you look in the newspaper or if you look online for prices, they're written kind of differently than stock prices. Bond prices are all designated as a percentage of par. So if you look here, we have a quote of 87.562, right? That's 87.562% of par, or $875.62. So if you just take the decimal place and move it 2 points, that will be the price if you're talking about a corporate bond or a municipal bond. They're both recorded price-wise the same way. Now, for U.S. Treasury and agency bonds, they're stated in 30 seconds of a point. So when you see 94.16, that translates to 94 and 16/30 seconds, or 94.5%, and that would be selling for $945. So again, the price of the bond depends on its coupon and its maturity and also the interest rates in the market, and that's incorporated into these prices. So let's talk about some characteristics or some features of bonds. So the first feature to talk about is something called a call feature. Essentially, the way this works is when a company wants to refinance its debt, it needs to pull back the old issue that's at a higher coupon and reissue debt at a lower interest rate or a lower coupon. So if this call feature, if it's called, this creates a little bit of a danger, if you will, for the investor, because you can't control when this happens. So in times of declining interest rates, call features become very critical, and we need to understand the impact on our investments. Now, debt can be freely callable. That is, they can retire this debt anytime they want. It could be non-callable, which means they can never call this debt back or can never retire it prior to maturity, or it could be deferred. And this is the way a majority of debt is they have a deferred call feature. So that basically says there's a date certain. So it's issued and it's a 30-year bond, and they say, well, for 10 years, we won't call it. It'll be deferred until 10 years. So anytime after 10 years, they can call back this debt. And again, this is a great advantage to corporations because it allows them to refinance their debts if interest rates are indeed falling. So how do they do this? There is a call premium. This is essentially the amount that's added to the par value to help compensate bondholders for this callback. And typically, it's the par value, right, plus the call premium. And the call premium is usually 1 year's interest rates. So again, this allows us to refund this debt, if you will, so that we can buy back this high coupon debt and replace it with lower coupon debt. Again, that is an advantage to the issuer, not to the investor. Most most bonds have a sinking fund, and a sinking fund basically stipulates how the company has to pay off its debt over time. Again, this typically only applies to term bonds, those that are, maybe a 30-year straight type of a bond, right? And this sinking fund is typically attached to companies that may have some financial issues. So typically, this will require the company, after a couple of years, to start to pay back the debt. So how they will do this is they'll do a calculation. It's a time value calculation, and figure out on average how much do they have to retire each year, so that the last year of the bond's life there is a smaller amount of debt out there, so that it won't be this huge lump sum payment. I mean, imagine a company borrows $500 million and they never pay back a penny for 30 years. And in 30 years, on a certain day, they need to have $500 million in their checking account. So this is just common sense, conservative money management to want to have a feature that allows you to pay off this bond. So what happens is, when they figure out what this amount is, every year they will take that amount of money and put it in an account. Now, what does that money do in that account? Well, this is really a corporate finance question, but essentially what they do is, if bond prices are right, that is, if they're selling at a discount, they'll take this money and they'll buy back the debt, because they're buying it back at a price less than what the par value is. However, if the bond is selling at a premium, they'll let that money sit there and earn interest until comes time that they find it appropriate then to buy back some of the debt. So it's just a way to create a function that requires corporations to manage the funds that they have. Different types of debt, right? We have secured debt and we have unsecured debt. So senior bonds are referred to as secured obligations, right? This is typically senior bonds are secured obligations. That is, they are backed by some type of an asset. Like a mortgage bond is secured by real estate. Corporate trust bonds are secured by financial assets, and equipment trusts are secured by pieces of equipment like boxcars or airplanes. So if the company runs into trouble and they have to pay back the debt, say they go into bankruptcy, the first things that get paid back is this secured debt. So they're first in line, if you will, to receive any payback that comes from companies that may find themselves in trouble. So secured junior bonds are what are referred to as unsecured debt. That is, they're backed only by the promise of the issuer. So a debenture is the word that describes or is defined by something being totally unsecured. It means there's no collateral backing up the obligation. So debentures can also be what are referred to as subordinate. What happens if the company has a series of debt issues that follow each other? Those that come later are referred to as subordinated. They are junior to this other debt. So that means secured debt is paid first. Those are the things that have collateral. And then comes the junior debt. But the junior debt can also have a priority ranking depending on when the money was actually borrowed. Now, income bonds are a kind of an unsecured debt. There's no asset that backs them up, but the income of the project backs them up. So there is some security, if you will, but the only security there is if the cash flow actually occurs. So if a project happens and we issued a bond for it and interest is supposed to come from the cash flows from the project, what if the project goes bust? Then that debt then will default because it doesn't have a cash flow to make the payments. Bond ratings are very important in that they give us a very quick picture of the security of an investment, right? So higher ratings are typically associated with more profitable companies. They have less debt, more liquid, they're stronger cash flows, and they don't appear to have trouble servicing their debt. So companies such as Moody's, Standard & Poor's, they go through a financial analysis of the company, and they evaluate the probability of default. So investment grade bonds are the top ranking, if you will. These are financially strong, well-run companies with very little chance of default. When you go down this rating system, things become riskier and riskier. Junk bonds reflect a group of debt where they are less than investment grade quality, and these issuers may be lacking financial strength. They may actually just have a lot of debt, right? Because debt is one of the things we look at. So a perfectly good, strong company can still have a junk bond if they have a substantial amount of debt. When these companies rate the debt, they also, from time to time, will disagree with each other. So there could be split ratings, that is, the two companies looking at these debts could give different outlooks, if you will, on the safety of the debt themselves. So essentially, ratings are tied to bond yields. The higher the rating, the lower the yield, because ratings reflect risk. So lower risk things should have higher yields, or lower yields, excuse me. So this has an impact. What happens when for some reason, the rating changes? When the rating changes, the yield changes. When the yield changes, of course, the price changes. So this gives us, as investors, a kind of a shortcut, if you will, to understand the riskiness of a debt. So from time to time, there are some challenges with the ratings, but in general, they give us a good picture of the riskiness of a bond.